In today's episode, I'll talk about two interesting stories. In the first story of the day, I'll talk about China's new crackdown on rare earth exports that could change technology supply chains and alter global balance of power. And in the second story of the day, I'll talk about how private credit is now changing the lending space and what it really might mean for businesses and the global financial system. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 16th of April. Let's begin with the first story. See, China has recently imposed major restrictions on the export of several rare earth elements and the magnets that these elements are used to create. Now, this might seem like a small thing to you at first, but the thing is, in reality, it has the power to reshape technology supply chains across the world and also shift the geopolitical balance in quite a big way. And the reason of this is that rare earth elements are absolutely critical for making many of the advanced devices and machines that we rely on, right from fighter jets to electric vehicles and even wind turbines for that matter. And when one single country controls so much of the production or processing of these materials, it can use that very position as a form of leverage in global trade. But before diving deeper and understanding why this is so significant, let's first take a very quick look at a concept called weaponized interdependence. See, this idea was introduced in 2019 by two political scientists called Henry Farrell and Abraham Newman. Now, they showed that global trade and interconnections are not always about equal benefits for all sides. In a very tightly connected world, certain countries end up controlling things called choke points. Basically, for your reference, a choke point can be a central shipping route, a powerful financial network like SWIFT, or a rare resource that a very few people can produce. And when a country has power over one of those checkpoints, it gains two major abilities. First, it can keep an eye on whatever passes through that channel, like tracking financial transaction as an example, and it can cut off someone else's access to that channel entirely. Now, the United States has for a long time done this by using SWIFT and its dollar clearing systems to enforce sanctions or monitor money flows. Farrell and Newman's research showed that once you have control over a crucial link in the global economy, trade suddenly stops being a balanced risk for all sides. Basically, if you catch hold of a choke point, you can hurt your opponent a lot more than how much they can hurt you, and you can do it simply by shutting down their access altogether. Now, China, after watching the United States use these tools for very long, has now started to develop its own forms of leverage. Now, one of the most powerful areas of control is the production and processing of rare earth minerals. Now, for your context, there are 17 rare earth elements, and the funny part of it is that despite the name, they're not actually always rare in the Earth's crust. But the thing is, the real challenge is that they are rarely concentrated in large amounts, which are enough to make them easy or economical to mine. But over the years, China has invested heavily on finding, extracting, and refining these very rare earth elements. It has reached a point where it dominates global supply chains, particularly for the heavier rare earth elements, which are often found in lower quantities. And these heavier elements are used for high strength magnets as specialized components which can handle a lot of heat or stress. Now, with some context in place, let's understand what's exactly going on right now. See, on 4th April, China decided to apply export restrictions on 7 of these 17 rare earth elements. Basically, now companies that want to send these elements or their related magnets out of China will now suddenly need special licenses. And of course, this alone as a piece of news would be big news for any industry that really needs them. But the thing is, it is also an escalation in the ongoing trade war with the US. See, according to the Center for Strategic and International Studies, or CSIS, China's move came right after President Donald Trump raised tariffs on Chinese products, which was itself part of the recent surge of aggressive measures in this long economic conflict. Basically, the moment US put high tariffs on goods from China, Beijing retaliated by restricting materials that are very vital to modern technology. Now, the impact of these restrictions could be absolutely massive. These rare earth elements are used in manufacturing advanced fighter jets like the F-35, which needs more than 900 pounds of them for all its sophisticated systems. And it's not even just fighter jets. In more everyday items, these elements also show up in electric car motors, wind turbine generators, semiconductor chips, LED lights, and the capacitors that companies like Nvidia rely on for their high-end processors. Now, the New York Times reports that nearly every speck of the dysprosium in the world, which is about 99.9% of it, comes from mines in China. And that means that if you're a tech company or a defense contractor anywhere else in the world, you are very highly dependent on these Chinese suppliers, and that is where a concept called choke point becomes so important. Now, of course, the US is obviously aware of how risky this dependence can be. It has exactly one main rare earth mine in operation, which is at Mountain Pass in California. Now, this mine can produce significant amounts of lighter rare earth elements, but the thing is, the country has not built enough of its own refining capacity yet. The heavy rare earth remain more challenging, and the US still sends most of what it mines abroad for processing. But China, on the other hand, keeps an overwhelming share of the world's refining capabilities under its own control. Until 2023, China processed 99% of the global supply of heavy rare earths. Vietnam, on the other hand, had a refinery that provided a small alternative, but according to CSIS that I mentioned earlier, the plant has been shut down for over a year due to a tax dispute, leaving China effectively unchallenged in this entire area. So therefore, seeing this vulnerability, the US Department of Defense has now poured money of over 439 million US dollars since 2021 into projects that are aimed at building a full domestic supply chain for this. Their plan is basically to go from extracting these minerals out of the ground all the way to making the magnets used in advanced hardware. Companies like MP Materials and Linus Rare Earths have received tens of millions of dollars each to set up new processing facilities or even upgrade their existing facilities. But the thing is, these efforts will take time. You just cannot build a large-scale mine or a refinery just overnight. So therefore, the US is still years away from becoming truly independent in this particular field. But the big picture here is that all of these developments are happening amidst an escalating trade war. And this particular conflict dates back to Trump's first presidential term when he began imposing tariffs on China, and it intensified when the Biden administration introduced targeted export controls to slow China's progress in semiconductors. Now, each side, of course, has repeatedly responded to the other with more and more tariffs and new rules. The relationship has grown colder over the past decade, but it also took a very sharp turn in early 2025. On 1st Feb 2025, Donald Trump placed a 10% tariff on Chinese imports, claiming that it was meant to stop China from sending fentanyl into the United States. And a few days later, China responded to this by restricting exports for several minerals like tungsten and indium, which can be used in both civilian tech and military hardware. And soon after that, Trump announced a huge 34% tariff as part of what he called Liberation Day tariffs. And ever since then, these two countries have been trading further tariff hikes that have at times reached triple digits as well. And these measures have only pushed Washington and Beijing to become even more suspicious of each other's intentions. But underneath it all, both governments see trade not just as a matter of money, but also as a tool of national security. Where countries used to talk about globalization as a force that would bring them together and lower the chances of conflict, they now view economic ties as possible weapons. China is very well aware that it has a powerful lever through its control of rare earths and other strategic materials such as graphite, gallium, and germanium, which it has already restricted for the US. So if the conflict continues to worsen, it could curb exports of still more specialized inputs like certain chemicals or advanced battery components. But on the other hand, the US could step up its own restrictions on China's access to cutting-edge technology, block Chinese investments in US companies, or even limit Beijing's ability to operate in the global financial system. Each side is looking at the other and looking at vulnerabilities that can be pressed over here. And all of this is leading to what some analysts call the collapse of the rules-based international economic order. It used to be that a network of global institutions and agreements helps settle trade disagreements and keep things running smoothly. But as trade becomes more about security concerns now, those old rules and norms seem less stable as time passes. The world is moving towards a more fragmented system now, where countries may try to build self-sufficient supply chains and avoid being caught off guard if a partner suddenly decides to pull the plug. Of course, this process could be painful, long, and full of economic disruptions because so many industries built their businesses around the assumption that goods and raw materials could flow freely across borders. So if I were to summarize everything together now, China's rare earth export restrictions are a great example of weaponized interdependence playing out in real time. A resource that many in the world require is largely controlled by just one country, and that one country is now using it as a bargaining chip in a larger trade war. The United States and the the other nations now have to decide how they want to respond, which means pouring billions into new mines and refineries or actually striking a deal with China. But if the standoff continues, it could affect everything from smartphone production to renewable energy projects to even military hardware. On that note, let's move on to the second story of the day. See, if you are in need of a loan to run your business, who would you imagine you'll go to? See, most people would think of asking a bank or maybe a non-banking financial company or an NBFC. But the thing is, there is another enormous lender out there which is now quietly growing into a multi-trillion dollar force in finance, and that is private credit. Now, private credit was not on anyone's radar in the early 2000s, but now it has exploded into an industry that is valued anywhere between 1 to 2.5 trillion US dollars depending on whose numbers you can trust. It has even grown large enough to rival the entire global high yield bond market. And because of the massive size and the speed at which it has grown, it has also attracted the attention of big organizations like the IMF or the International Monetary Fund, which is wondering if this could be the next major financial risk that is hiding in our plain sight. But to get a sense of what private credit really means, let's first start by understanding how a traditional bank loan even works. See, typically, if you borrow from a bank, you will deal with fixed requirements, regulatory checks, and standard rules about how you can use that money. Now, in many cases, some banks might decide that you do not fit into their lending criteria at all. But private credit, on the other hand, is money that is lent outside the normal banking system by specialized investment funds. Now, these funds are managed by firms like Blackstone and Apollo. And over here, instead of relying on deposits or short-term funding, which is the way banks do, these funds raise their investment capital by locking in their own investors, which are also called limited partners, for several years at a time. And once they have this locked in money, they directly lend it out to business and hold on to those loans until they mature. Now, these private credit loans often carry higher interest rates than bank loans do. A typical bank loan, for example, might come at a 5% interest rate, but private credit, on the other hand, could charge you 8% or even more for that matter. But still, many borrowers are willing to pay a higher price to get the deal done more quickly, or to borrow more than how much a bank would allow them, or to even secure more flexible repayment terms. And unlike standardized bank products, each private credit deal can also be customized to a requirement. And there are also different forms of private credit. One of the most common one is direct lending, which goes straight into mid-sized businesses. Then there is mezzanine lending, which combines traits of debt and equity and sits at a riskier part of the company's financial structure. There is also asset-based lending, which is supported by real estate or equipment as collateral. And then there is also distressed debt strategies, where the lenders buy loans that are in big trouble at big discounts, and they hope that they will someday bounce back and become profitable again. Now, after the 2008 global financial crisis, banks started pulling back from lending. They were basically loaded down with troubled loans and burdened by tougher rules like Basel III, which required them to hold more capital against riskier lending. And this created gaps in the market, which are spaces where companies still wanted to borrow money, but they could not really get it from banks. And that's why private credit funds rushed to fill those exact gaps. Their timing was obviously great because over the decade following the crisis, interest rates hovered at historic lows, and large investors like pension funds, insurance companies, and sovereign wealth funds were all hunting for returns that were higher than what they could get from government bonds. Now, private credit promised them yearly returns in the range of 8 to 9% when certain government bonds were barely giving them 1%. One study by the Bank for International Settlements even showed that in countries with lower policy rates, the private credit market had grown much faster. And that is how private credit established itself as a serious lending option, often competing with banks on price while winning on flexibility and speed. Now, much of the money that flows into these funds actually comes from sophisticated investors like pension funds, insurance companies, and sovereign wealth funds, like I mentioned, who are comfortable locking up their capital for some time. But that said, it is no longer just about these big players. In the US, for example, something known as Business Development Company or BDC is increasingly giving everyday investors a chance to put their money into private credit as well. Already, BDCs are estimated to have over $300 billion under management. And if you talk about Europe, there is a talk of a new regulatory structure like the European Long-Term Investment Fund and Long-Term Asset Funds, which might expand the pool of private credit investors. So as more and more retailers are starting to come into this, regulators are suddenly starting to worry that if the market suddenly hits a rough patch, everyday people could really suffer heavy losses, and that could sort of send ripples across the broader financial system. One important part of this entire piece is the borrowers themselves. Usually, they are middle market businesses which are large enough that they need a sizable loan but not quite big enough or stable enough to issue bonds in the public markets. In the United States, they frequently have revenues between 100 million and a billion US dollars. And interestingly, many of these businesses are backed by private equity themselves. According to some counts, 78% of private credit deals in the US involve private equity sponsors, while in Europe it is about 42%. And this, of course, can set up scenarios where the same parent group that owns the equity in a company is also lending the debt to that very company, which sort of creates tensions over whose interests come first. Private credit has also spread in different ways across the world. North America, for example, is the main hub which makes up about 87% of global private credit. Over there, private credit accounts for over 7% of all lending to non-financial companies. In Europe, on the other hand, it is only about 1.6% of corporate lending, but it is growing very, very quickly. Some reports say that it could be expanding at 17% a year, and it looks a bit different from that in the US because there are less private equity sponsorships and overall there is a less usage of leverage by the funds themselves. But if you talk about Asia over here, Asia is relatively newer to private credit as compared to US and Europe because we have only about 0.2% of total corporate credit, but that has been growing at 20% annually. Most activity is in places like Australia, Singapore, and Hong Kong, while it is also gradually reaching emerging economies like India. Asian private credit usually deals with acquisition financing, which is lending to companies that do not have many hard assets, or distressed financing where traditional banks might be too cautious. So this very expansion has brought up some very serious questions about the risks that are hiding beneath. The first concern is that many of these loans carry floating rates, which basically means that if central banks raise interest rates to fight inflation, the borrowers' interest payments start to increase as well. Some borrowers have started using payment in kind arrangements where instead of paying interest in cash, they add it on top of their loan principal. Now this of course can temporarily reduce what they owe now, but it also increases the total amount owed in the future. Recent data suggests that the share of payments in kind, interest in the income of business development companies, has doubled since 2019, which may indicate that more companies are stressed by higher rates and they are papering over problems for the time being. The second worry is that private credit deals do not trade in liquid public markets, so the loans do not get repriced very regularly. High-yield bonds and leveraged loans have public market prices that go down when investors see more risk in them. But private credit, on the other hand, can continue to show stable valuations on paper even when economic conditions start to worsen down. So if enough borrowers struggle at once, the sudden recognition of losses could come as a shock which could potentially rattle investor confidence in a very big way. The third issue is the concentration of risk amongst certain investors. See, large pension funds and insurance companies have poured big chunks of their money into private credit as well as other liquid assets like private equity or real estate. In the US, private equity linked life insurers now manage over $1 trillion with about 20% of their assets in illiquid instruments compared to only 6% among more traditional insurers. Some of them have also used extra leverage or derivatives which can further amplify losses if values start to drop. Now the worry here is that if a serious wave of defaults or downgrades start to hit portfolios, the damage could spread beyond just the original borrowers or funds. Then there is also a layered leverage problem over here. See, even though a private credit fund itself may borrow modestly, its borrowers might actually be leveraged and the people investing in the fund may also be borrowing money in order to invest. And this creates multiple layers of debt in the system. So if things go wrong ever, these very layers could start magnifying losses and also cause a rapid cascade of sorts. One more growing trend here is the creation of semi-liquid fund structures where investors can withdraw their money more frequently. And just in case they all decide to do so at once, the fund suddenly may not be able to find new buyers for its illiquid loans immediately, which could potentially create the kind of run on funds that triggers instability. But that said, despite all of these concerns that I just mentioned, private credit has definitely shown some surprising resilience through several big events, including the COVID-19 pandemic, when traditional markets wobbled quite a bit. Private credit managers usually take pride in hands-on relationships with borrowers, which they believe helps them manage problems much more smoothly than the others. They have remained generally optimistic about their future, even though they are well aware that rising rates and economic uncertainty could test their model in ways that has not been tested before. Regulators and global bodies like the IMF are now suddenly taking a closer look at this as well. They have begun calling for tighter monitoring and possibly stronger regulations, warning that the private credit sector's size, complexity, and relative lack of transparency could be setting the stage for future shocks. Many people see parallels with what happened with shadow banking after 2008 when lawmakers scrambled to close regulatory loopholes once the damage was already done. The question here this time around is whether regulators can step in preemptively or if the world will only and only act after a crisis has occurred. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Tata Sons is set to receive a record 32,722 crore rupee dividend from Tata Consultancy Services or TCS for FY 2025, which is the highest ever payout from its flagship IT firm. This follows a 24,931 crore interim dividend already paid for the first 9 months of FY 2025. To give you a comparison, the FY 2023 dividend stood at 30,418 crore rupees. Second, OPEC has reduced its global oil demand growth forecast by 150,000 barrels per day each for 2025 and 2026, revising the projections to 1.3 million BPD and 1.28 million BPD respectively. This marks the first downward revision since December 2023. Third and the final one for the day, India's cut and polished diamond exports declined by 16.8% year on year to 13.3 billion US dollars in FY 2024-2025, marking the lowest level in nearly 2 decades as per data from the Gems and Jewelry Export Promotion Council or GJEPC. This drop pulled down the total gem and jewelry exports by 11.7% to $28.5 billion compared to $32.28 billion in the previous fiscal year. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.